It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
I just couldn't believe how many of these Chinese electric cars are on the roads. Brands like BYD, they're gaining attention with this aggressive pricing. They've got new models and growing consumer acceptance. We seem to now be in the space of saying, yeah, I'm prepared to buy a Chinese electric car. Tesla does remain a major player, but its dominance is being challenged as buyers just have more options to choose from. If I held Tesla shares today, I would be selling them, no doubt about it. You know, the share stock value in Tesla can only go in one direction is my best guess, and the days of market domination for Tesla in the EV space are probably over. But right now, let's go to Sydney and catch up once again with Margaret Lomas. When we last spoke, you were sort of catching your breath with relation to the budget and some of these announcements, especially for investors in property. Now that we're sort of settled down somewhat, I know you want to just sort of go over and just lay some of the groundwork because there are still some confusions out there with different people.
Look, absolutely. And I think when an announcement like let's remove negative gearing is made by a government, investors immediately panic and think that what this means is that buying an investment property means that all of the expenses of that property is laid right at their doorstep with no recourse or access to any kind of relief through tax benefits for those expenses. And it makes it seem like a really daunting proposition to buy a property where rent's coming in but expenses far exceed that rent and there's not much you can do about that. And I really want people to understand that while it's not ideal, it's also not the end of the world because it should work like this. I do want to put a caveat on this, and this is subject to confirmation because, you know, this budget's come out with so little detail and no real idea on how it's all going to be implemented. But reading the budget papers and having a look at the notes, the way I understand it is it should work like this. First of all, your expenses can be written off to the degree that your rent covers them. So you get X amount of rent in, so you don't pay tax on any of that rent if your expenses wipe out that income. So that's the first thing. Your expenses are deductible, but they're only deductible against income from property. So your investment or property income. Any more that you've got, and let's face it, for most people in those first few years of owning a property, before you're able to raise the rents, before you're able to maybe reduce your repayments through debt repayment or by getting some equity in that property, in those first couple of years, normally your expenses are more than the rent. So there'll be some left over. What is proposed is that leftover is carried forward as a carried forward loss to future years. Now, when you have investment losses, they can be carried forward indefinitely until you have either a capital gain or a future profit in the form of income to write it off against. So if you find yourself with a loss from your property on your expenses, that loss gets carried forward every single year and it accumulates. And what that means is that when that property begins making a profit because your expenses are now lower than your rent, you can begin writing off that profit and therefore paying no tax on it through these accumulated losses. Or if you sell the property, those accumulated losses can be written off against that now larger capital gains tax that you have to pay because of the changes to capital gains tax.
The ABC ran a story about a woman on the Gold Coast who spends her retirement travelling in a motorhome with her two dogs, but not by choice. For the past 3 years, she has been living in her vehicle while waiting for social housing. Now, before you make any judgments or jump to the wrong conclusion, the woman that we are talking about used to have her own business. In fact, she had retired early at just 40 years of age and was living a comfortable lifestyle. She was a self-funded retiree, until she lost all of her properties due to fraud, and then unable to work following a serious car accident. So living on the streets can, literally by her definition, happen to anyone. Many women don't feel safe in shared housing. You know, it's stressful and it causes many anxiety issues, especially for older women around Australia. But rising rents means that they often can't afford to live alone. And whilst this is happening on the Gold Coast Council receives about 3,000 complaints related to people living in cars and vans across the region every year. So that is a sad indictment on where we are in the housing market at the moment. A couple of weeks ago, we took you back to 2023 to look what the market was doing back then. This morning we thought, let's do this again, and we're going to take you back to October of 2024 with some comments on where we were with a snapshot back in time.
It's fair to say that we're moving through a very diverse market. We always say that Australia is not one housing market, but at the moment in particular, there's a really wide range between the top performers, Perth, Adelaide, Brisbane, Melbourne, Canberra, Darwin and Hobart, which each saw quarterly declines. Sydney is still up, but I think that's because it's a market that historically has been relatively constrained when it comes to new levels of supply. At the moment, it's being driven by more affordable pockets of the market that offer house and land for a growing number of young families. And even though market values are still rising, you can even see momentum coming out of the Sydney market. As you say, that 0.5% lift was one of the softer growth rates that we've seen in the market over the past few years. It's down from 1.3% in the June quarter, and it's down from a 2.5% quarterly increase for the September quarter of last year. So at 0.5%, we can see it's definitely slowing.
Yeah, so, if you're in Sydney and you're saying, oh, gee, it's not much of a rise, it's very, very slow, just compare yourself to Canberra, Hobart and Darwin and Melbourne, which is all down, which circles us back to Perth, Adelaide and Brisbane. They saw that slower momentum, as I suggested, although they did continue to perform, and that's the positive side for those markets.
Yeah, absolutely. Anyone who has owned in Perth or Adelaide pre-pandemic has seen extraordinary cumulative change in home values. Since March of 2020, Perth's home values are up 75%, or the equivalent of a $341,000 increase in the median value. Adelaide has seen similar performance, up 69%, or an additional $330,000 added to the $330,000 added to the median value, and Brisbane sitting up 66%, or $350,000 added to the median value.
Don't navigate the real estate market alone. Let us help guide you in the world of real estate every day. Make better informed decisions with the latest news and insights.
Now, property decisions, they are often driven by emotion, headlines and opinions, but successful investors usually rely on evidence. In other words, looking beyond median prices and focusing on deeper market signals that can reveal opportunities others miss. Are investors spending, do you think, enough time analysing data before making their next property move?
No, we know they're not. We know that's really clear to us, even just talking to our own customer base. So we can see that at the coalface, that's not the norm of how Australians are buying. We also have a lot of data around people buying close to their own home, underperformance of, say, units versus houses, people that are making a sale of a property within a certain amount of short years that are not selling at a profit. So you can see people that have bought into markets there that were underperforming and have got out because it's not making them any money and it's a real cost burden for them. So we know for sure that the general public aren't getting access to those tools. And the other difficult thing that you mentioned there, the headlines that's driving a lot of the emotion for investors, is that they treat a market as one and a whole. So, for example, I'm in Melbourne today. You'll see in the paper non-stop in the headlines that Melbourne is down X%, yet all of our markets that we're buying in are in a double-digit growth in the last 12 months. So they're outperforming the market because you don't buy Melbourne, you buy a particular street within a particular suburb, and you've got to get really granular in terms of the data at that level, not talking about a market that deep and wide.
In buying property, it's not just about finding the right home or investment. It is also about, of course, understanding the negotiation process. This is big. Vendor motivation, buyer competition and market conditions, that can all influence the final outcome. So with millions of dollars changing hands every day, how many buyers are leaving money on the table because they negotiate the wrong way? It's a big one.
Yeah, this one is really close to my heart, Craig. I've spent the last 30 years doing over 4,000 property deals, and I sat on the agent side for 23 of those years. Based on my own research, I think Australians are leaving about $50,000 on the table for every $1 million that they spend. And the reason is it's very simple and easy as an agent to manipulate your emotions to get you to pay that emotional premium, which is what we're employed to do. Whilst that system remains in play and the motivation is to work on the vendor side, who's your employer, they're going to extract and push and pull as much as they can to get you to pay an extra $10, $20, $30, $50,000 in that instance that I just used as an example. The reason why most people can't reverse that is because they don't understand the psychology of a seller, the agent, the motivations, how to ask the right questions at the right time, how to leave space after their questions of silence to understand how an agent responds and the nuances that are involved in that. And then the magic is in that listening and asking the right questions. And when you do that, Craig, you can really unlock some super value. So I think that, if you're inexperienced in that space, you need to work with an expert negotiator because they will add a tremendous amount of value. And it's that third party leverage that makes a significant difference. Very difficult to negotiate you versus an agent. When you can start to include talking from a third person, it's a lot easier in a negotiation with an agent.
Grab your weekly dose of inspiration to help build a real estate portfolio. Learn from the professionals and know your property with us.
Let's take you to Brisbane right now to catch up with Asti Mariasmo, the chief economist from PRD. And you have got a new report out today. It is called Where to Buy Next, Capital City Suburbs Offering Value in a Competitive Market. And your report is showing affordability is improving across several capital cities, giving buyers more options than they had before. Sydney, Brisbane and Melbourne are seeing more suburbs fall within reach, especially in the unit market. So Asti, first off this morning, where are the smartest opportunities emerging for buyers right now, do you think?
So definitely affordability at the moment has improved slightly across all of the capital cities, which is always great news. One thing that I do have to say, Craig, is that these are definitely not the cheapest suburbs that you can find in each of these capital cities, but it is as affordable as we could find it to balance things like livability, so making sure that you can access your amenities like your schools, shops, hospitals, making sure that the crime rate is as low as possible as well. Also making sure that there are some new projects and new development, particularly residential development, to make sure that if you are looking to buy a new build, then you're able to do so.
Okay, and your report also shows that units are becoming one of the biggest opportunities at the moment for first home buyers and investors across Australia. In Brisbane, Melbourne and Sydney, affordable unit options have increased. Am I using that right? Significantly creating pathways into the market. A lot of first home buyers are asking, is choosing a unit now providing the best balance between affordability, lifestyle and future growth potential? So I'll get you to expand on that one.
Absolutely. So units at the moment is definitely showing the biggest value. What we have found is that across all of the capital cities, so that's Sydney, Brisbane, Melbourne and Hobart that we covered in this report, we've seen an increase in the number of suburbs where the median unit price is below the relevant capital city. For example, we have seen an increase in the number of suburbs in Sydney where the median unit price is below the median unit price for Sydney Metro itself. And that is definitely a great finding and something that is really, really good for buyers right now. In Brisbane, for example, when we did this report last year, only about 40% of suburbs within 20 kilometres from the CBD in Brisbane is considered affordable, which means that it's below the Brisbane median unit price, whereas this time around, 66% of units or suburbs that are within 20 kilometres from the Brisbane CBD is considered to be affordable in the sense that it has a lower than the median unit price for Brisbane capital city. And again, like you've just said, to balance that affordability with livability. And at the moment, most of the stock that are coming onto the market are units. So it increases their chances of being able to get into the market.
And talking of growth areas, Albany in WA is no longer just an historic, sleepy coastal area. It's one of the most competitive and impressive regional real estate hotspots in the country at the moment. If you have a look at the median house price, that is sitting just over 1.1 million. Annual house growth is up by 25.5%. Which is pretty impressive, but not as impressive as what I'm about to tell you with the median unit prices. At the moment in Albany, that will cost you over $822,000 with an annual unit growth of almost 150%. What a standout.
It definitely is. I think we're going to see a lot more of those type of growth and type of prices as we go along, with a lot of the new taxes that are coming on as well for developers to be able to actually develop new product, which then of course makes it a little bit more scarce in terms of new supply as well for developers to make it, financially viable. We will definitely start to see certain pockets where people may not have considered it before, but as soon as they see a new development, they're all running towards it because new investment tax laws and things like that.
We connect you to the best real estate information across Australia. The Real Estate Podcast.